I'd like to particularly thank Salim Awani, Managing Director at RBC Capital Markets, who's a client, a friend, and most of all, a very talented liability management banker for helping us with today's presentation. Melissa, can you turn to the next slide? Before I turn it over to Salim, a quick overview of our agenda. We're going to talk about an overview of liability management and the benefits. Then we'll go into each of the different ways that we use to manage liabilities: redemptions, open market repurchases, debt tender offers, exchange offers, and consent solicitations. Each of the sections that we're going to talk about will have Salim introduced from a business standpoint. We'll then talk about some of the legal aspects, and then we'll finish up with a couple of tax thoughts on each of those areas. So without further ado, let me turn it over to Salim Awani of RBC Capital Markets to talk about an overview of liability management and benefits. Salim?
Great. Thanks, Eddie. So kicking off here on page 4, let's just start with the basics here. What is liability management? It's any form of secondary debt management, and this is in contrast to the debt capital markets team or the high yield capital markets team, which is primarily concerned with issuing new debt. I like to joke with them that I have to, serve as the liability management person, is the person who has to clean up all their messes. So I'm dealing with the secondary side of things, not necessarily the primary side of things. Summarily here, we've addressed it as we manage, modify, and optimize debt portfolios for our issuer clients here. And there's 3 real concepts that we sort of boil down to, which, you see this is called the Olympic rings here of liability management. We're looking at retiring debt, we're looking at refinancing debt, and we're looking at modifying debt. Within those circles are the 4 main types of transactions that we deal with here in liability management, and we're obviously going to go into detail on all 4 of them. But it's very simply open market repurchases, or these are secondary buybacks in the open market. There's cash tender offers, which is really the backbone of liability management. That is the principal transaction or the most common transaction that we employ, which is a public offer to buy back securities for cash. We either do that in the form of a retirement exercise for cash, or alternatively in a refinancing exercise where we retire those securities in conjunction with a new issue, which is designed to fund that tender offer. Further, there's the exchange offer, which essentially combines a new issuance with a tender process and combines them together. And then finally, the simplest of the transaction, but potentially the trickiest to execute under the modification circle here, is the consent solicitation, which really refers to indenture modification. Flipping over to slide 5, why do issuers look at liability management? Look, there's a number of reasons. You can sort of pick a few out just automatically, where you're seeing, why do people retire debt? They're looking to delever. They're looking to reduce interest costs. We also see that in the refinancing context when you have high coupon debt and trying to replace it with lower coupon instruments. There's a series of math that we run here on our side when we talk to issuers about the economics. And this is, again, a discounted cash flow analysis of looking at taking out an existing piece of paper, the cost of that relative to the economics of a new piece of paper and the cost of that instrument. There are more qualitative reasons why we do these types of transactions, including increasing financing flexibility, extending maturities, the perception or belief that you could lock in longer-term attractive rates today. There's sometimes rating agency reasons why you want to do this, or cap structure reasons why you want to move debt from various boxes in your cap structure that give you some qualitative benefit. There's also the accounting concerns here of recognizing, do you have a gain, do you have a loss on the retirement of debt early, and as well as tax implications as well. Are you accelerating taxes payable or not as part of the exercise? I'll now flip it back to Eddie to kick into the hows of going through the various elements here.
Great, thanks. Next slide. So if we think about the various options that Salim mentioned, we could think about them a little bit on this slide, all the way from the left in terms of the least documentation to the most documentation, which of course is what lawyers are often concerned about, the least time consuming, the most time consuming, where redemptions and repurchases can be done fairly quickly, fairly easily. Debt tenders get a little bit more complicated. Exchange offers, whether they're exempt from the SEC registration or registered are a little bit more complicated. And finally, debt for equity or equity for equity exchanges can be much more complicated, much more time consuming. So let's move on to the next slide. And again, this is a bit of a rehash of what Salim just mentioned. Redemptions all the way to the left of our little chart are just purchases of the outstanding debt securities for cash in accordance with their terms. So you have the ability to repurchase the securities. The nice thing about that is it's at the issuer's option, and bondholders don't have any choice in the matter. Repurchases, you go out and you offer to repurchase the securities. You may or may not get people to take you up on it, but it's just repurchasing. And a tender offer is really just a larger version of an open market repurchase, where you're going to publicly announce that you're going to repurchase, tender offer the securities. It may be that it's an any and all, where you'll buy anything that comes in, or you may put a limit on it. Next page, please. So if the issuer doesn't necessarily have cash and is trying to do a liability management transaction, there are also non-cash alternatives. Exchange offers, they can be private exchange offers. They can be exempt exchange offers, so those are more public, but they're not SEC registered. We'll talk a little bit more about that later. Or you can do registered exchange offers as well. You can do a one-off exchange with just one individual investor or one or two individual investors, where you could swap debt for equity or equity for equity, depending on what your goals are. And then, as Salim mentioned, you could just do a consent solicitation, where you're just amending the terms of the outstanding indenture. There's no cash required, although, as we mentioned here in the parenthetical, there is typically a consent fee that is payable. Next slide, please. So in terms of choosing among the alternatives, you really have to look at, first, what are the issuer's objectives? What are you trying to do? Are you trying to delever? Are you trying to give yourself a little bit more room in covenants? Are you trying to get rid of debt and replace it with equity? So a lot of that will tell us what alternatives we're going to use. It will also depend on the issuer's financial condition. Distressed exchanges, where an issuer is in financial distress, obviously at that point it won't have the cash to repurchase bonds. It may not even be able to do a consent solicitation and really get what it's looking for in terms of relief, so it may have to do an exchange so that it can retire some debt and issue equity. There are preventive liability management issues where you see something coming down the road, and that could be a consent solicitation. It could be other things as well. And then there's some just opportunistic transactions. Salim mentioned working with his DCM colleagues. We do this not infrequently, where with relatively low interest rates, an issuer may decide that they just want to refund some of their securities, and so they can issue a new security at a much lower interest rate and take out high coupon debt, or just extend the maturities. And again, lastly, in terms of choosing among the alternatives, as Sully mentioned, you've got legal issues, accounting issues, rating agencies, regulatory capital if you're a regulated financial institution, tax considerations, which of course you then have to call in one of our colleagues like Brennan to help with. So with that, that's a bit of our overview, and now we're going to turn it over to Anna to talk about the first of these, thinking ahead. In terms of trying to think through the alternatives, you also have to look at not just what are my objectives, you have to look at, are there any constraints to what I can and can't do? So credit loan facilities may limit your ability to prepay debt. It may limit your ability to redeem debt. It may limit your ability to issue new debt. There are other terms of the securities. For example, with a consent solicitation, you may need 100% of bondholders, which is extremely difficult to get. You may have to pay a consent fee to all of your bondholders if you pay a consent fee to any of your bondholders. You may need trustees' consent, other things like that. A consent solicitation could involve the requirement to register the securities under some circumstances. So you have to think through all of those. And then finally, the use of proceeds. What are you really trying to do with the proceeds of a new issuance, or if you're taking out debt? So sorry, with that, we're now going to finally turn it over to Anna to talk about redemptions.
Okay, so redemptions, if we go back and think about the chart that Eddie showed and the continuum, redemptions would be among the easiest of the alternatives because redemptions are usually built into the mechanics of the debt securities. The possibility of a redemption would be baked into the securities at the outset when they were issued, and generally would be provided for as an alternative in the terms of the securities and the indenture if the securities were issued pursuant to an indenture, or in the terms of the note if the securities weren't issued pursuant to an indenture. and would allow the issuer to essentially take out the debt securities at a particular time or from a particular date forward at a particular price. Most debt securities have a non-call period, so providing the note holders some assurance that they're going to be receiving coupon payments for at least a period of time, so some call protection. Other debt securities, as we indicate on the slide, are going to prohibit redemption. But in any event, to the extent that a redemption is allowed, as I mentioned, it's the indenture that's going to provide the instructions for how a redemption can take place. And usually a redemption is going to require some notice on the part of the issuer to the trustee. The trustee is then going to provide notice to the holders through the DTC clearing system. And if not all the securities are going to be redeemed, usually there's a process that's specified. So we'll go on to the next slide. A redemption may prove to actually be a relatively expensive option as liability management options go. And for that reason, it might actually be unattractive. So the redemption price generally is going to be the face amount or a premium to the face amount. So for example, if you're thinking about a company that is in distress, then this is going to be a pretty expensive alternative. So some other alternatives that we're going to go through may be, on balance, more attractive. What makes redemption a possibility is that for a company that's in good financial health and has lots of potential alternatives, redemption is, as I said, pretty easy, pretty painless. So next slide. In terms of other considerations, if an issuer is thinking about redeeming, always, as a public company, the issuer should think about what else is happening at the company when it's choosing to redeem. So what other material non-public information does the issuer have at the time that it's making this decision of potentially redeeming the securities, and how is it going to handle the redemption notice? So usually the indenture is going to set out the kind of notice that has to be provided to the holders, but that's just one piece of the puzzle. If we go to the next slide, we'll see a case in point. The SEC issued a cease and desist order against a bank in connection with how it chose to handle the redemption of securities. And this is around the time of the financial crisis. So it's now kind of dated, but it provides some lessons. And the point here is that the fact that an issuer is going to redeem securities may be interesting to the broader market and to holders of its securities generally, not just to the class of affected securities. And here, the SEC came to the conclusion that the redemption was material to the securities generally of the issuer just based on trading prices. So something to think about for issuers generally, not just looking at the four corners of the indenture, but looking more broadly at how a redemption may be viewed by holders of other classes of its securities and by holders of its securities generally. So with that, I'm going to turn it back to Salim to go through debt repurchases.
Yeah, I mean, the first section here just on debt repurchases, you know, there's a couple different paths from an execution standpoint for doing open market repurchases. And you know, the way that is most commonly done here is an issuer will engage an RBC or another bank who is active in the secondary market to go and purchase securities in the open market on behalf of that particular issuer. There are many instances where an issuer gets a phone call directly from an investor and therefore can engage with that investor directly and actually purchase securities from that party. The other alternative, and we refer to this at RBC as a reverse inquiry basis, is sometimes our trading desk has positions which we will just call an issuer and say, hey, we we either have a position or in touch with a seller. Do you have interest? There's a little bit of a different where we're not an agent in that case. We're actually acting as principal. The benefits here of an open market repurchase, if you flip to page 19, generally speaking, when you do transaction in the open market, you're doing it discreetly. You're able to do it with very little legal costs, very little legal documentation, and the pricing for that open market repurchase tends to be very attractive or very close to secondary market level. And so there is some benefits here for issuers who are looking to buy small amounts of their debt to do that in the open market. And that's really where we end up pushing issuers to do open market repurchases versus some of the other alternatives. I'll flip it back to Eddie to go through 20.
Thanks. So as Salim mentioned, doing debt repurchases are relatively easy, and there's generally relatively little documentation involved. But one of the really important things to do and to think about and think about really when you're structuring it is to avoid the tender offer rules. You don't want open market repurchases to be considered a tender offer because then you're subject to certain of the SEC's tender offer rules. So whether it's a privately negotiated deal or open market purchases, you might accidentally fall into the tender offer rule. So there are no definitions. There's no definition in under the Williams Act or the 34 Act of what a tender offer is. So that's not all that helpful if you're trying to avoid a tender offer. There's what we call the 8-factor Wellman test. Came from an old SEC case against somebody named Wellman. And in that case, they came up with 8 factors as to what constitutes a tender offer. So some of the things that we look at are, is it active and widespread solicitation of public shareholders? So you don't just call one person or have a reverse inquiry with one person. It's a substantial percentage of an issuer's the class of the securities. So if you're just buying a couple of shares or you're buying just a few securities, that's not going to be a tender offer. It's made it a premium over the prevailing market price. That's often the case, although as Sully mentioned, repurchases could be just at market or very close to it. They're firm. The terms are firm rather than negotiable. So if you go to somebody and say, I'll offer you 98 for your bonds, and that's it, I'm not going to negotiate, that looks more like a tender offer than you're negotiating. That's not really a take it or leave it, isn't really a negotiation. So a number of these other things in here are really indicative of kind of what you think about in terms of what would be a tender offer. Widespread solicitation, public statements to people. It's only open for a limited time. So those are the things we look at. Next slide, please. So when we're doing open market repurchases, we really want to avoid the tender offer rule. So we generally follow the following guidelines. Number one, it should be for a limited amount of securities. You would never do an open market repurchase for an entire class. It just wouldn't work in any event, but we certainly don't want it to be for a majority or a large part of the class. It should be a limited number of people, so you shouldn't be calling everybody and anybody who you think has a position. It'd be great if they were all sophisticated, but they don't necessarily have to be. It should be over some period of time. You don't want it to be, hey, we've got to do this in the next 3 days. You've got to get back to us. If we don't hear from you, deal's off the table. The prices should be individually negotiated. You can go to somebody and say, we'll offer you 98, but we don't want you to go and say, the offer's 98, take it or leave it. We'd say, we're offering 98. Let us know what you think. And if somebody comes back at 98 and a half, you talk to them about it. And finally, to the extent that you're going to accept something, you really should be accepting on an individual basis. So if one person says 98, that's wonderful. If you negotiate with somebody else, you don't want to say, well, I'm only going to buy you out if the first person comes in, or I'm only going to buy you out if I can get 20% or I can get another percentage. So those are some basic rules that we think about to avoid the tender offer rules. Next slide, please. Some other considerations to think about with open market repurchases are, number one, even if you're doing this on a very private basis and you're only talking to 1 or 2 people, does that communication to the investor trigger disclosure under SEC Regulation FD? Regulation FD, Regulation Fair Disclosure, Reg FD, says that when an issuer discloses material non-public information to certain classes of people, like market professionals or people who hold their securities, they may have to tell the rest of the market. So you want to make sure that you don't trigger a requirement to issue a press release or put out or file an 8K. Oftentimes, issuers will go and test the waters and call a couple of people and say, I'm interested in a repurchase program, or I may even be interested in an actual tender offer, but I just like to test the waters and just see what people think. And again, you want to make sure that the testing of the waters itself isn't going to trigger the FD obligation. So it'd be great if people are subject to some kind of confidentiality arrangement. We have what are called over-the-wall procedures, where people can orally or through emails agree to keep things confidential. But you also have to think about, as you're talking to people, what are you going to tell them? Are you going to tell them we want to repurchase some securities? Are you saying that we're doing a huge financial restructuring? And what information can you give out that's not going to trigger things like that? So something to think about. And then finally, material non-public information. You want to make sure that when you are talking to people and you are buying back the securities, remember good old 10b-5 says you can't, or insider trading laws say, you can't buy or sell securities on the basis of non-public information, material non-public information. So if the issuer, here's a great example, if the issuer said, I want to buy back the entire class, and I'm willing to buy it back at 99, is it material non-public information to go to a couple of people ahead of time and say, I'd like to buy your bonds at 97? And then you buy them back at 97, and a week later, you do a tender offer at 99, and these people come back and say, well, wait a second. Why didn't you tell me about that? That's a kind of a tricky situation, but there's certainly other things about, for example, earnings. If you think that your earnings are going to be particularly good or particularly bad, should you be disclosing that before you do an open market repurchase? A real whopper would be changes to credit ratings. So for example, if you know you're about to be downgraded and you offer to buy securities, well, presumably the securities will drop in value right afterwards. Now, an issuer might say, I'm not going to buy back my securities if I know they're going to drop in value, but maybe your credit rating is going to go up. So those are the kinds of things you have to think about in terms of material non-public information and disclosure. Moving on to the next slide. The last one to think about is Regulation M. So in Regulation FD, Regulation M is part of the distribution rules, and it says it's unlawful for an issuer to bid for, purchase, or attempt to induce any person to bid for, purchase, or covered security during the applicable restricted period. Okay, so we talk about, well, gee, what does a distribution have to do with debt securities? Well, it may be that repurchases of convertible debt could be deemed to be a forced conversion, and thus that constitutes a distribution of the underlying equity security. Another one could also be that if you are doing an equity offering and you decide you want to buy back some convertible debt, the convertible debt could be deemed to be the equity security that you are distributing. So again, just something to think about in the back of your mind. If it's straight debt, you normally don't need to worry about Reg M, but if it's convertible debt, certainly something to think about. And with that, we're going to actually turn over to Brennan for our first tax minute of the day.
Yeah, thanks, Eddie. So real quickly here, we're just going to cover the tax consequences to the issuer and the holder. These consequences apply the same to redemptions and repurchases, so we're covering them in one go. So it kind of depends on whether you're repurchasing at a premium or a discount. If the issuer is repurchasing at a premium, then the premium may be deductible to the issuer, treated as an interest expense. And to the holder, it's probably going to be capital gain subject to the market discount rules. If the issuer is repurchasing at a discount, that could be that'll generally be cancellation of indebtedness income, so an income recognition event to the issuer, to the extent that the repurchase price exceeds the adjusted issue price. And then to the holder, it's going to be capital gain or loss, subject to some special market discount rules. And in the case of the, obviously in the case of a repurchase at a discount, it's usually going to be a capital loss. If we go to the next slide, I just want to point out here, it's a little bit complicated, but in general, even if there is a related party debt repurchase, so a related party to the issuer repurchases the debt, that could still result in cancellation of indebtedness income. And that can even be the case where there is a indirect repurchase of the instrument that by a party that then becomes related to the issuer. So it's just something to keep in mind, again, at a high level. So with that, I'm going to hand it back over to Salim to talk about, kick us off with debt tenders.
Great. So as previously discussed, the tender offer is really the backbone of liability management. This is the most common type of transaction out there. If you look at the spectrum on the bottom of this page 27, We talked about the two bookends, right? So on the extreme right-hand side is the redemption or make wholes that are available in the notes, where you can retire the whole shebang, but it tends to be quite costly unless it's a relatively short-dated instrument. And on the extreme left-hand side, which again we just went over, is the open market repurchases. So if you're looking for generally a small portion of the outstanding, you go with that type of approach. The tender offer occupies really the sweet spot or the middle here. And there are different structures that issuers employ. The most basic type is what we call the any and all tender offer, which we'll go into some of the benefits of that, because you can do that in a very short time period. But it's a blunt instrument. You're essentially telling investors, hey, anyone who wants to come in, I'll accept you. The other alternatives are what we call partial tenders, where we tell investors, listen, we're not targeting the whole security, we're only targeting a portion. The advantage of going for a partial type of instrument here is that you create some price tension with investors, where investors say, geez, you're not trying to take out the whole thing, there's only a portion of it. And there's a couple different structures we can employ. One is the Dutch auction, where you tell an investor, listen, I'm only buying back a portion of the bond. You tell me the price at which you want your purchases, your bonds repurchased at within a range, so you create some price tension in that regard. Or the waterfall structure, where you target multiple securities, you rank them in the order in which you're willing to accept them, and you have a single price point for each of those securities. You have a maximum cap across multiple tranches, and the idea there is that if there's an investor who is trying to be difficult and trying to bargain for a higher price, you just simply tell them, okay, well, if you don't want to participate, that's fine. I have 3 other securities behind you. So those are the basic type of constructs that you tend to see. Of the structures, I'd say the most common types you will see in terms of tender offers is either the waterfall or the any and all structure. Dutch auction, you typically see in more emerging market type debt or high yield debt. You don't see it as frequently in the investment grade side of things. Flipping to the next page, we're talking about why you do the tenders. Again, is if you want to target a larger amount than you think you can buy back in the secondary market, but you don't want to pay the full make-whole redemption side of things. We do often have tender offers combined with new issuances, I mentioned, in a refinancing context. You can make tender offers conditional on new financing, and so that's an advantage of using that type of structure, where you can pair the two together. Also mentioned, when you do tenders, there's oftentimes we include something called an exit consent. So when we talk about consent solicitations later in this deck, you can actually do a consent as part of the tender offer, where you strip or remove all the covenants, which acts as a very nice stick to get investors to continue to participate in these tender offers. I'm now going to flip it back to Eddie for page 29.
Thanks. Okay, so we're actually going to go a little bit out of what might seem a logical order, and we're going to start off with tenders for convertible debt, some of the legal issues. As Salim, I think, can probably attest, we see a lot less frequently tenders for convertible debt than we do for straight debt, but tenders for convertible debt have a lot more legal issues involved with them, so we thought we'd start with that. So under the SEC's tender offer rules, convertible exchangeable debt are treated just like equity securities, because in essence they're convertible into the equity securities, so they're treated like equity securities, and therefore the SEC's equity tender offer rules apply. So what are those? Number one, you have to file a Schedule TO with the SEC. It's subject to SEC review. You may have to amend it. So there's an SEC filing, whereas in straight debt tender offers, we typically don't. We're subject to the all holders rule, meaning the offer has to be made to all of the holders of the class. Doesn't mean you have to buy all of the securities, but the offer at least has to be made to everybody. The best price rule says that you have to offer to pay to every holder the best price that you're going to pay to any holder. So therefore, that limits your flexibility in terms of being able to pay, for example, an early tender premium or something like that. So also, for example, with the Dutch auction rules, Dutch auctions say that each person can bid what they want to get. So somebody could say, I'd like 98. Another person could say, I'd like 99. Another one could say, I'd like 99.5. And the issuer, of course, would say, I'll take the 98 guy first, then I'll take the 99 person, and I'll take the 99.5. So instead, we do what's called a modified Dutch auction, where you look for clearing price. At what price can you buy all the securities you're looking for, and then you pay everybody that price. That's the best price rule. The tender offer has to be announced publicly. You see these ads in the Wall Street Journal that go from the top to the bottom and have an awful lot of boilerplate in them. The tender has to include withdrawal rights for the offer period. And then finally, the issuer can't make any purchases outside of the tender for some period of time. Moving on to the next slide, please. So some things to think about when you're tendering for convertible debt that would be different than for investment grade debt. Number one, as I mentioned already, you can't sweeten the tender offer with an early tender premium. That would violate the best price rule. There could also be accounting implications because remember, you're not just buying back debt, you're also buying back the ability to get equity. There may be options embedded in that, and so much more complicated accounting issues for the issuer. There also may be some hedging agreements that the issuer has entered into in connection with originally issuing the debt, so you have to look at how that's going to affect any hedging arrangements or call spread agreements that they have. And then finally, as we talked about in the last section, a tender of convertible debt could be deemed a forced conversion and could have Reg M implications. Okay, so let's move on to the next slide, and we're done with convertible debt. So we're going to talk a little bit about straight debt. So straight debt is still, even though it's not convertible, it's still subject to a number of SEC rules. It's Regulation 14E, which are the anti-fraud rules, and the rules under that are 14E1, 14E2, and 14E3, but they're not subject to a lot of the other ones that we just talked about. Tender offer can be subject to a number of conditions to closing, including receipt of financing, or as Sully mentioned, exit consents. Not at all uncommon where you're taking out debt or you're refunding debt, that you would have it subject to the issuance of some new bonds. Generally, under the 14E rules, a debt tender offer has to be open for 20 business days. If it's extended, it may have to be held open for another 10 days, depending on what the extension is or if there's a material change in the pricing. And you have to extend, when you do an extension, you have to announce that in the press. So those are some of the 14E rules. Regulation 14E does not require a filing of tender offer documents. So the next thing is you can prepare all these documents, and then when you're ready to launch the tender offer, you just typically send it to your information agent, who sends it on to DTC, and then you can start your tender offer. Moving on to the next slide, please. Okay, so as I mentioned, Rule 14E1, Rule 14E says that you have to keep your tender offer open for 20 business days. The SEC has historically looked at investment grade debt a little differently than non-investment grade debt in terms of having to keep the tender offer open for a certain period of time, and has actually issued no action letters over the course of time and also given informal guidance on how you can go about doing an investment grade tender offer that's just a little bit different than what the rules say. So for example, you don't necessarily have to keep an investment grade debt offer open for 20 days. We'll talk about that in just a minute. In terms of pricing, there's some interesting ways that the SEC will allow you to price based on fixed spreads over Treasury that are either calculated on a daily basis or real time. So if you tender at 10 o'clock, you get one price, and if you tender at 10:15, you get a different price. And very importantly, when we're talking about investment grade versus non-investment grade debt or fixed income versus convertible, it's important to recognize that hybrid debt and certainly trust preferred securities, although people aren't really issuing them much anymore, you still have quite a number of them outstanding. We typically treat those as debt, not as equity, even though they're called trust preferred securities. We typically treat those because they are fixed income instruments and they're really just a pass-through for debt instruments. So moving on to the next slide. I mentioned the SEC has given us some guidance regarding debt tender offers. And so through a number of no action letters, we've done a number of different things. I mentioned the 10-day business offer, the holding investment grade tender offer open for less than 20 business days. We'll come back to that. Anna's going to talk in a couple more minutes about no action letter that the SEC issued for abbreviated tender offers. And so a lot of people would say, well, gee, now that there's this great no action letter, I don't need to worry about how you used to do things. When Anna describes the new abbreviated tender offer rules, they're extremely helpful. They are used not infrequently, but there are certainly a number of conditions to the ability to use them, and so therefore it doesn't always work, and so therefore you have to understand the other way to do shorter form tender offers, and so you have to understand some of the old SEC no action letters. So let's move on to the next slide, please. So under the old SEC guidance, you were able to hold a debt tender offer open for less than the 20 business days and the 10-day business extension rule if the following conditions were met. One, the offer to purchase was made for any and all of the debt securities. So it couldn't be a partial, it had to be any and all. Number two, it was open to everybody. It was conducted in a way to get everybody the information quickly. And if it was going to be open for less than 10 days, so up to as short as 7 days, you had to have some way of getting the information out to everybody very quickly. And most importantly, the tender offer was not made in anticipation of a tender offer by somebody else. So you couldn't try to front end somebody else's tender offer. Now, again, when you're talking about investment grade debt, it's very uncommon that you're going to have a third party, and certainly a hostile third party, making a tender offer for your debt. But again, the idea was we don't want to let you do it on a quickie basis to front end another transaction. Moving on to the next slide, please. So as I mentioned, there are a couple of no action letters issued to investment banks about the pricing of tender offers. So Salim will tell you that an awful lot of the tender offers done now have a fixed spread, where the spread is just figured out at one point and it applies to the entire transaction. So you might say that we'll, on day 10 or day 11, we'll fix the price. We know that it's going to be a fixed spread over an identified treasury, but we're not going to fix it until we're well into the tender offer, and then we're going to fix it, and that will apply to all of the tenders in the tender offer. The SEC has also said, though, that you could use fixed spread pricing where you price it every day during the tender offer, subject to a couple of things. And moving on to the next slide, we also have real-time fixed spread, where you could actually tie the price that which somebody is entitled to the treasury security at the time of the actual tender. In those situations, obviously, there's a lot more disclosure that you have to provide, and you have to be able to give people ways to calculate things. So much more complicated, and haven't done that in quite some time. Moving on to the next slide. So thinking a little bit about the difference between investment grade and non-investment grade debt under the old SEC guidance. Investment grade debt could be, a tender offer could be held open for as little as 7 or 10 days. Again, if it's under 10, you have to have a way to get the information out very quickly. If you are going to extend it, it has to be held open for 5 calendar days. It has to be made to everybody, and you can use fixed price spreads or real-time fixed price spreads as well. On the other hand, if you're doing non-investment grade debt, again, this is under the old SEC guidance. It had to still be open for 20 business days in accordance with the rule. The offer had to be extended for 10 business days. You could use fixed price spread pricing, but you had to fix it 2 days before the expiration of the exchange offer, the tender offer. The last thing I want to talk about before I turn over to Anna and talk about abbreviated tender offers is material non-public information. A question that often comes up is, I want to do a tender offer, but I may or may not have MNPI. How do I deal with that? Well, general guidance is you can't purchase or sell securities when in possession of material non-public information. So some of the questions that we get, and Salim and I have been on calls with issuers that say, I'm about to announce earnings. Does that mean I have to wait until my earnings are over, have been announced, to launch my tender offer? So depending on the practitioner and depending on the circumstances, some people get comfortable that you can launch the tender offer before the earnings come out, so long as there is a period of time before the tender offer is completed or before withdrawals cut off, where the earnings are out, so that people will then have the benefit of the earnings before they need to make their final investment decision. Again, facts and circumstances. Another question that we often get is, well, I'm going to do a tender offer, and whatever I don't get in the tender offer, I'm then going to redeem. Do I need to announce the redemption? That's both a legal and a business question. The legal question is your intent to redeem the securities material non-public information? And certainly some investor might say, if you're going to do a tender offer at 97 and then buy the securities at 100 under redemption, yes, I certainly would have liked to have known that. That would be material. And that's a question we often have to deal with. And obviously the non-legal question is, if you're going to be a frequent issuer and you're going to have to deal with your shareholders or bondholders, do you really want to be in a position that you are purchasing securities at a price lower than a redemption and then announce the redemption right after the tender offer. Probably not a great bondholder relations move. Other MNPI kinds of questions that come up have to be done on a case-by-case basis, but the SEC's tender offer rules do include anti-fraud provisions. 10b-5 applies, so think about what's going on. We typically don't have disclosure opinions in debt tender offers, but again, think about that. And with that, let me turn it over to Anna to talk about the abbreviated tender offer rules.
Thanks, Eddie. Okay. So as Eddie mentioned, the SEC staff issued a no-action letter in 2015, and then the staff in the M&A group issued compliance and disclosure interps in 2016 that clarified a number of the technicalities relating to some of the points that I'm going to go over. To amplify on what Eddie said, the no-action letter guidance provides for relief for abbreviated tenders or exchanges, and this is relief that's available in specific instances. It's very helpful if you fit the criteria. It doesn't mean that it's going to be available in every single instance. It's available for non-convertible securities. So for converts, you still need to look at the guidance that Eddie went through. It's available regardless of ratings. So high yield is fine. It applies, as we say in the slides, to both investment grade and non-investment grade. The offer does have to be made for any and all securities of the subject class. We'll go on to the next slide. In terms of the conditions, I'm going to go through the conditions relatively quickly. So it's an offer that has to be made by the issuer. So again, to the point that Eddie made earlier, it's not available for third-party tenders, so that's pretty rare. The consideration, there's some limitations relating to the offering consideration. So the offer consideration can consist only of cash and qualified debt securities. So you see there the definition of qualified debt securities. So qualified debt securities that are identical in all material respects to the targeted debt securities. We'll go on to the next one. So it can't be financed with debt that's senior. So what do we mean by that? Senior debt would be a class of securities, for example, that has guarantors or has collateral, whereas the subject class didn't, for example, or that has a weighted average life to maturity that's shorter than the subject class, or that's otherwise from a priority stack more senior. There are a variety of conditions relating to dissemination and public information. So immediate widespread dissemination of the offer. For public companies, it's relatively straightforward. A Form 8K filing for reporting companies, immediate widespread dissemination of the offer through a press release, pretty rigid timetable in terms of getting the press release out, and then having the press release contain certain basic information about the offer, having an active hyperlink to where you can find more information, and then using commercially reasonable efforts to email all of the information. And obviously, you're going to have the help of your information agent to be able to do all of this for you. In terms of the pricing mechanisms, so you're allowed to use the pricing mechanisms that Eddie talked about. So you can use the fixed, or you can use the fixed pricing or the fixed spread to a benchmark. Either of those would work. You can't include early settlement features, so that gives you, somewhat less flexibility than you might have had otherwise. We'll go on to the next slide. In terms of material changes, so if you make changes the offer has to be extended, so at least 5 business days from and including the announcement of a change in the consideration offered, and then 3 business days from and including the announcement of another material change. So that extends it, but if you look at the all-in time period, it's still relatively time efficient. We'll go on to the next slide. A number of disqualifying events here, things that take you out of being able to rely on this abbreviated relief. So you can't use it in connection with an exit consent. So often we're trying to engage in a liability management exercise and get covenant relief, and we do that in connection with a consent solicitation. Can't use this, so you would have to default to the prior no action letter guidance. You can't use it if there's already been an event of default, so you'd have to think ahead and have gotten relief in advance. Can't use it in a bankruptcy or other distress scenario. Can't use it if there's a material acquisition. Can't use it if there's a tender that's contemplated. So a number of things that take you out, but obviously still super useful if you're engaging in an opportunistic transaction. And that's where we see it used most. So we'll go on to the next slide. So here, just leaving you with a number of considerations for investment grade debt in terms of what the prior no action letters allowed. And you can sort of compare, contrast the prior no action letters versus the relief that I just outlined. And then a last thought in terms of just how information is disseminated. So we'll go on to the next slide, Melissa. I talked about the dissemination requirements, the widespread immediate dissemination via press release, and then if you're a public company, the 8K. So a lot of these transactions rely on exempt offerings. Obviously, the widespread dissemination would be considered a general solicitation. So that's something to sort of bear in mind if you're trying to square that with a securities exemption in the context of an exchange, obviously not really applicable in the context of a tender. So with that, Brennan, off to you for next slide for tax.
Thanks, Anna. So the consequences of a tender are very similar on the U.S. tax side to the consequences of a repurchase or redemption. So I'm not going to go over that again. Just one extra item for these to consider is the early tender premium, or a sweetener, I think as Eddie called it. The question is, what is that? Is that additional interest? Is that some kind of a fee, or is that additional consideration? There's a private letter ruling from the IRS which implies that the earlier tender premium is interest expense to the extent that it is attributable to accrued interest. But I think you'll find that most places in the market, the early tender premium is just treated as extra consideration for tax purposes.
So on 49 here, in terms of the exchange offer here, which, if you think about it logically, it's essentially a combination of a tender, a buyback, with a new issue, except that you avoid the trip to the new issue market. So there's no cash raise here. You're directly swapping investors from bond A to bond B. It is the more complicated type of transaction, so you don't see it as frequently as you would see, for example, a tender offer with a new issue or a call redemption with a new issue. But there are some very specific reasons when you do see it. For example, in distress situations where you have a scenario where a issuer does not have access to the new issue market and wishes to extend term, for example, or wishes to move bonds from an unsecured to a secured position to try and capture discount. We also see it in capital structure scenarios. So, for example, in the change of an obligor to shift from one box in a cap structure to another box in a cap structure. And then finally, on the investment grade side of things, there is a slight benefit to an exchange versus a tender and refi from an accounting standpoint. If you flip to page 50, I've tried to compare just so you can see the pros cons of the alternative being a tender or a redemption with refi versus an exchange. You can see the yellow indicates where the pros and cons lie. So for an exchange offer, really, there's an accounting treatment benefit where if you're retiring a premium bond, instead of having to take that hit up front, subject to some accounting tests, you may be able to amortize that hit over the life of the new security. That tends to be a driver, as I said, on the investment grade side of things. And then the last piece there about the idea of being in a self-financing transaction, I don't need to make a trip to the new issue market, is actually quite helpful sometimes on the high yield or distress side of things. When it comes to the tender and refi, again, that's a more common trade. Why is it more common? It's more flexible, right? Someone can come out of the old note, doesn't have to buy into the new note. They're not forced to enter the new security. You're also able to do the new issue versus in a more traditional sense of the book building process with price stock, et cetera, whereas in exchange, you have to put that pricing up on day one. I'll now toss it back to Eddie to talk about 51.
Actually, I think that's me.
Oh, sorry.
Yep.
That's okay. So exchange offers, I'm going to go through the alternatives with exchange offers. So an issuer can conduct an exchange offer pretty quickly and efficiently on an exempt basis, which we refer to as a private exchange offer. So relying on the exemption under 4A2 for the statutory private placement exemption. So here, the issuer through the exchange agents is going to pre-qualify the holders and ensure that the holders are qualified institutional buyers, QIBs, or institutional accredited investors before sending to them any of the materials regarding the exchange offer, so the pre-certification relating to their status. And of course, the securities that are issued in the exchange are going to be restricted securities. So that's clearly going to be less than ideal, depending on the circumstances. Under certain circumstances, as we note on the slide, they may be able to tack the holding period or may simply be able to rely on establishing a new holding period under 144 for their securities. We note they could require reg rights, less frequent for debt securities. So next slide. Another alternative, we'll go on to the next one, to 3A9. So 3A9 provides an exemption for exchange offers where there is no consideration changing hands, no cash consideration other than de minimis cash consideration. And here, the securities that are exchanged are going to have the same character as the securities that are being surrendered or tendered. So, for example, if you have registered securities that are being given up, the securities that are going to be received are going to be freely tradable. If you're exchanging securities that were restricted, the securities that are being received in the 3A9 exchange are going to be securities that are being that are restricted, and so on. But of course, because there is no cash consideration, a holder can tack. So very helpful. 3A9 is very limiting, though, because you won't have the benefit of having an exchange agent like an RBC be able to actually advocate and solicit and put forward all of its efforts and explain the transaction necessarily to note holders. They would have to act in a more passive way, simply performing ministerial functions, and wouldn't be able to get paid a percentage of the principal amount of the securities that were exchanged. In addition, there are 5 requirements in order to meet the conditions for the exemption. So the securities have to be of the same issuer. That sounds really simple. There are tons of no action letters that give more meaning to what that means. And, you know, it's more complex when you think about whether you can fit into same issuer, a finance subsidiary, a a partially owned subsidiary, an entity that was used to issue trust securities. So there's a lot more color there. No additional consideration from holders, which I mentioned. Next slide. The exchange has to be offered exclusively to existing security holders. And then, as I mentioned, the issuer can't pay a commission for the solicitation of the exchange. And there's the general anti-evasion clause that you see at the end. Next slide is the point that I made, the same character. Finally, you can always choose as an issuer to register the exchange. Less common, you see this more as part of a distressed transaction or a recap where an issuer is undergoing a more fundamental restructuring, and the issuer is undertaking an exchange offer in connection with a more fundamental recapitalization of its capital structure, usually bringing in new equity infusion, new credit lines, for example. So this is a full SEC registration, SEC review. Next slide. Because it's a registration statement, it's subject to traditional Section 11 liability. You're issuing new securities pursuant to an SEC registration statement, so you may have distribution considerations under Reg M. I'm going to turn it to Brennan for tax considerations on the next slide.
Yeah, thanks, Anna. So I recognize that we are almost out of time. This is a fairly deep topic. If you ask any of my colleagues, a tax lawyer can talk to you about this one for a long time. I'm not going to do that, but there's generally the question is, when you're exchanging a debt instrument for another debt instrument, is that exchange something that amounts to a significant modification? There's a bunch of tests for that. We have them here on the slide. I mean, as the name kind of implies, the core of the matter is whether or not the changes are economically significant. So just know that if you exchange one debt instrument for another, it is possible that that's not even treated as a taxable event or an exchange for tax purposes. If we go to the next slide. For the issuer, it's kind of the same as a cash purchase, although it gets a little tricky to determine the issue price, or it can. Repurchase premium can be deductible again. OID can potentially be created in the case of an exchange. Then on the holder side, if we're talking about a corporate issuer, it is possible for there to be a recapitalization depending on the terms of the securities. If you have one of those, these are the same rules as a tax-free reorganization. The exchange of one note for another could be a non-recognition event, such that there's no taxable income. If you don't have one of those, if you're either not a corporate issuer or it's a significant modification in total, then you're going to have gain or loss to the extent that the new debt instrument's issue price exceeds the adjusted issue price on the old debt. So with that, I'm not sure if anyone wants to say a quick word about consent solicitations, or if maybe we just open it up to questions here and flip to the CLE code.
Why don't we, I think we can do that in about 4 minutes. So Salim, do you want to walk us through the business side? I'll do the quick legal side, and then we'll give you the final CLE code.
Sure. So the quick and dirty here on consent solicitations is scenarios where you just want to make small modifications to the covenants of an indenture, of an existing piece of paper. You typically offer investors a consent fee. On the right-hand side of page 61 are some of the factors that dig into what that consent fee ends up being. Again, depending on the gravity of the change, the threshold you need to pass the change, whether it's simple majority or a super majority, how the voting works, and then you look at various precedent trades to see what others have paid to get various covenant changes done. We flip to 62. We do talk about some of these restricted covenants that often need to get modified on the high yield side of things, on the investment grade side of things. The most common ones that you see being modified are things like reporting covenants or waiving and changing control. So again, there's some linkage there to M&A activity. Eddie, you want to take it on 63?
Sure. On the legal side, just a few things to think about. Number one, you have to take a look at the indenture to see whether what you're doing is permitted and or what the level of consent is needed. It may very well be that you need unanimous consent from each of the bondholders. So for example, under the Trust Indenture Act and most indentures, you need each bondholder's consent to change the principal or the interest or some of the redemption features. You have to look very carefully at the redemption features because some people try to tweak those a little bit. You have to take a look at it. But important to look at that. Another important legal aspect of this is if you are modifying the securities enough where you're fundamentally changing the nature of the investment. So for example, you're going from a 5-year note to a 30-year note, you're changing the interest rate, you're fundamentally changing everything. The SEC could deem that to be the issuance of a new security. And if it is an issuance of a new security, you have to look at what Securities Act exemption is available, or you may wind up actually having to register that consent solicitation. Next slide, please. In connection with a consent solicitation, obviously, you're asking people to give you something. A lot of people are hesitant to do that without there being a good reason. Now, it could be beneficial to them. So you could be helping the company do a great M&A deal and it's going to really help people. But some people are a little nervous about that. So there's typically a consent fee. And remember, the same people you're asking the consent from are going to continue to hold the bonds unless they sell it in the aftermarket afterwards. So some people would say, well, wait a second, not really comfortable giving you the consent because now I'm in a worse position. Sometimes when you do that, you would do it with an exit consent. So you'd say, look, I'll buy back your bond, but I need you to give me the consent on the way out the door. That can be very tough on bondholders who aren't tendering. So for example, gee, I got 80% bondholder consent and I'm stripping all the covenants out of the indenture. So therefore, the 20% of you who haven't tendered are now going to be subject to an indenture with virtually no covenants. So the SEC calls that a little bit sneaky or coercive. So think about whether you're going to do that. Another question that we see more probably in high yield is if you're going to pay a consent fee, the indenture may require that the consent fee be paid to everybody. There are a couple of court cases we talk about. Frankly, a couple of them were probably decided wrongly, and at least one of them was later overturned. But it certainly kept a whole bunch of people busy as to whether consents in certain situations did what we thought they would do, or whether they violated a provision of the TIA, whether you need it. Anyway, I won't get into it. You're welcome to read the presentation.
Exactly. So then the last point on the consent solicitations, it's very similar to the early tender premium. The question is, what is that well, backing up just 1 second, changing terms of an instrument can also result in a deemed exchange, just as equal to exchanging one debt instrument for another. Stripping out financial covenants as long as they're customary does not count. And then, as I said, the real question is the consent fee. What is it? Are non-U.S. holders of a U.S. issuer subject to withholding on those? And I think you'll find again here that in the market, most of the time, the position is taken that these are not something that there's withholding on.
It's in the chat. In a 3A9 debt exchange, does the new security have to be registered if the original debt security was registered?
Oh, okay. So as I mentioned, in a 3A9, just by operation of the exemption, the new security takes on the character of the old security. So if the old security was registered, the new security that's issued has the same character. It's considered freely transferable, and there's no registration of it required. It is considered to have the same character as the old security, so it would be issued with no legends, with a QSIP that indicates that it's not restricted.
Thanks. Thank you all for listening in. A special thanks to Salim Mawani for joining us today, and to Anna Pinedo, who stepped in at the last minute. Thank you all for joining us. You'll see on this last slide some additional resources. Please feel free to go to those, and we hope you enjoyed it and have a wonderful Juneteenth celebration day.